Hello, everyone. We have all heard the stories and seen the social media posts about people going rags to riches. The fascination of quick money from the stock market is incredibly tempting. You start with a little capital, make a few successful trades, and feel like genius. But what happens when that winning streak ends? What if that one wrong decision sends you spiraling down? In this video, I'm going to talk about the high stakes world of speculative trading and show you how the very same methods that used to build a fortune can also completely ruin you. So let's dive in. Please read the entire disclaimer carefully before moving on. So the first way to get both rich and poor in Indian share market is the intraday trading and scalping. Now, intraday trading involves buying and selling stocks within the same trading day. While the potential for quick profits exists, it is also a highly volatile and risk strategy. Substantial number of traders often rely on speculation, guesswork, and emotional decisions rather than sound research. Without proper risk management and a deep understanding of market movements, repeated losses from failed intraday trades can quickly deplete one's capital. In scalping, the trades last just for few minutes and sometimes even less. The outcomes are largely determined by a trader's skill, discipline, and risk management. So, how can you get rich by using this intraday trading and scalping? Excessive intraday trading and scalping can be highly profitable for those with a strong grasp of technical analysis, market dynamics, and strict discipline. The core idea is to make many small profits that accumulate into a large sum over the period of time. There are three key factors for success. First is small and consistent profits. A scalper might aim to make just a few rupees per share on a large volume of trades. Okay. Next factor is leverage. Traders use leverage to control a much larger position than their capital would normally allow. A broker might offer even up to 5 times the leverage. And third is the market volatility. Scalpers thrive on price fluctuations. They look for stocks with high trading volumes and frequent price movements. This strategy is to capture these small movements before they reverse. Now let's see how one can get poor in this intraday trading and scalping strategy. The same characteristics that make this strategy so lucrative also make it incredibly risky. A lack of discipline, poor risk management, and the unpredictable nature of the market can quickly lead to devastating losses. There are three key factors for the failure of this strategy. First is high transaction costs. The frequent buying and selling means that brokerage fees, taxes, and other charges can quickly eat into profits. A scalper who makes many small profits but also many small losses may find that the transaction costs outweigh their gains. Next factor is the leverage is a double-edged sword. While leverage can amplify gains, it also magnifies losses. A small adverse price movement can wipe out a significant portion of a trader's capital. A 1% negative move on a 5 lakh rupee leveraged position results in a 5,000 rupees loss, which is a 5% loss on the initial capital of 1 lakh rupees. Very important point. And the third factor is the psychological toll. The intense high speed nature of scalping can lead to emotional trading. A few losing trades can trigger a desire to make it back, causing the trader to take on even riskier positions. This is known as revenge trading, and it is one of the fastest ways to lose money in the share market. Okay, now let's move on to the another way, which is futures and options trading. Futures and options trading allows investors to take large positions with a small amount of capital by using leverage. This leverage magnifies both gains and losses. A small adverse movement in the underlying asset can wipe out the entire invested capital and even lead to losses exceeding the initial investment. This is a very common way for inexperienced traders to lose their money quickly. You must have heard SEBI's report about that. More than 19, in fact, I guess 95% retail investors loses money in FNO trading. Now let's see how can you get rich in FNO. FNO allows you to control a large value of assets with a relatively small amount of capital, known as margin in cases of futures and premium in case of options. A small favorable price movement in the underlying asset can translate into a massive percentage gain on your invested capital. Let's understand it with the help of a example, and we'll take the example of a futures trading. Now, a trader believes that the price of a particular stock, say company XYZ, currently trading at 1000 rupees will rise. Instead of buying 1000 shares for 1000 each, that would be 10 lakh rupees, they buy a futures contract for a lot size of 1000 shares. The broker requires a margin of only 1.5 lakh rupees for this entire transaction. This means the trader is controlling a 10 lakh rupees position with just 1.5 lakh rupees. Now the stock price rises by just 5% to 1050. So from 1000 to 1050, the value of the futures contract also increased by 5%. The profit is 50 rupees per share, which on a lot size of 1000 shares amounts to 50,000 rupees. So the trader's return on their initial investment of 1.5 lakh rupees is approximately 33%. How? So 50,000 profit in 1.5 lakh investment. So 33% profit. A 5% move in the stock becomes a 33% gain for the trader due to leverage. Repeating this a few times with a strong trading strategy can lead to significant wealth creation. So that is why this is very appealing. Now, let's see how you can get poor in futures and options. The same leverage that can make you rich can also make you poor. A small unfavorable price movement can wipe out your entire capital and even lead to a margin call where you have to deposit more money to cover losses. Let's try to understand this with the help of an options trading example. A trader buys the same call option for say 1000 rupees expecting the stock to rise. Now the stock price either stays flat or falls. Options have a limited lifespan and are subject to time decay. As the expiry date approaches, the options value erodes, and if the price of the underlying stock does not move in the expected direction, the option expires worthless. The trader's entire investment of 10,000 rupees is lost. If they make this mistake repeatedly, they can quickly go broke. Another risk is option writing, where the potential for loss is unlimited, especially for a naked option. A single wrong bet can lead to losses that far exceed the initial capital. So I hope you understand the risk involved in this futures and options. Anyway, let's move on to the next way, which is the invest heavily in penny stocks. Penny stocks are shares of small companies that trade at a very low price. These stocks are highly speculative, volatile, and often lack fundamental strength. They are susceptible to market manipulation and pump and dump schemes where promoters artificially inflate prices and then sell, leaving regular investors with worthless shares. Investing a large portion of your capital in these stocks is the fastest way to lose money. But let's see how you can get rich because people gets rich by investing heavily in penny stocks. So the primary allure of penny stock is their potential for multi-bagger returns. Because the stock price is so low, even a small increase in the company's valuation can result in a massive percentage gain. So let's try to understand this with the help of an example. Imagine you find a little known penny stock, say ABC Industries, trading at 5 rupees per share. You do your research and believe the company has strong business plan. a new product, and is poised for growth. You invest 50,000 rupees, which will get you 10,000 shares at 5 rupees per share. Now, the company's new product is a hit. It secures a major contract and its financial performance improves dramatically. This attracts the attention of a larger investor base and the stock price soars. The stock price, which was once 5 rupees, now trades at 50 rupees. Your 10,000 shares are now worth 5 lakh rupees. So you have made a profit of how much? 5 lakh minus 50,000, which is 4 lakh 40, sorry, 4 lakh 50,000 rupees, a 900% return on your initial investment. This kind of story is a powerful motivator for penny stock investors, and a few successful bets can lead to life changing wealth. Now, this is how you get rich. But what about how can you get poor in investing heavily in penny stocks? So the very same factors that makes penny stocks so appealing are what make them incredibly dangerous as well. The high risk nature, lack of transparency, and susceptibility to manipulation mean that you can lose your entire investment just as quickly. There are three key factors for failure. First is lack of fundamental information. Many penny stock companies are small, not well known, and have limited financial disclosures. It is often difficult to find reliable information to conduct thorough research, making your investment a gamble. Next factor is the volatility and illiquidity. Penny stocks are extremely volatile. Their prices can fluctuate widely on even the smallest news or rumors. Additionally, they often have low trading volumes, which means it can be very difficult to sell your shares at a desired price, especially if the stock starts to plummet. And the third factor is pump and dump schemes. This is a common forum this is a common form of fraud in the penny stock world. Manipulators buy a large number of shares in a low volume stock. They then create a hype campaign through social media, forums, and to encourage others investors to buy. As the stock price rises, the manipulators dump their shares, selling them at a huge profit. The price then crashes, leaving the unwary investors with worthless stocks. So, a prime example you might have heard recently about this the Bollywood actor Arshad Varsi and his wife involved in this pump and dump scheme. So, SEBI barred them for from the market for a couple of years, I guess. So, this is quite common in penny stocks. Now, let's move on and see the final way to lose or gain money quickly in Indian share market. It is the momentum trading. This strategy involves identifying stocks that are on a strong upward trend and buying them to ride the momentum. The goal is to sell the stock as soon as the momentum slows down or reverses. This requires constant vigilance, quick decision making, and a perfect exit strategy, which is one of the most difficult thing in this entire share market activities. A perfect exit strategy. Anyways, let's see how one can get rich. So, the momentum trading is based on the psychological principle that whatever is going up will continue to go up. A skilled momentum trader identifies stocks with strong upward trends, enter the trade, and rides a wave until signs of a reversal appear. The profit are made by capturing a significant portion of this price movement. Let's try to understand this with the help of an example. A trader notices that Tech Innovations Limited is showing strong upward momentum. Its price has been steadily increasing, its trading volume is high, and there is positive news surrounding the company. The stock is currently at 150 rupees. The trader buys a large number of shares, say 1000, for a total investment of 1.5 lakh rupees. The momentum continues for a couple of weeks and the stock price climbs to 200 rupees. The trader notices that the buying volume is starting to slow down. This is a potential sign of trend reversal. They decide to sell all their shares at 200 rupees. So the profit is 200 minus 150, that is 50 rupees for each share, and They have 1,000 shares, so 50,000 rupees profit. This is a 33% return on the initial investment in a short period of couple of weeks. By repeating this process on various stocks, a trader can accumulate significant wealth quickly. Now let's see how one can get poor in the momentum trading. The same psychological and market forces that drive momentum trading can also lead to massive losses. A momentum trader's biggest enemy is a sudden trend reversal, which can be caused by unexpected news, market-wide sell-offs, or a pump and dump scheme. It could be due to relying solely on hot tips from social media, unverified news sources, or friends. Such tips are often based on rumors rather than fact, and acting on them without due diligence can lead to investing in weak signals that are destined to fail. Let's try to understand this with the help of an example. A trader buys into Global Pharma Limited at 300 rupees, which is already overpriced. Mind that. Relying on the tip that the strong upward momentum will continue. They invest 3 lakh rupees buying 1,000 shares. Now, a sudden news report reveals that the company's new drug has failed a crucial clinical trial. The positive sentiment evaporates instantly, and the panic selling begins. The stock price plummets to 250 within a minute. The trader, unable to sell their shares quickly due to rapid decline and lack of buyers, is forced to exit the position at significant loss. So the loss is 300 rupees minus 250 is 50 rupees, and 1,000 shares is 50,000 rupees. So this single rapid loss wipes out a large chunk of capital. A trader who lacks proper risk management, such as setting a strict stop loss order, can see their entire capital vanish in few such events. Chasing momentum without a clear exit strategy is a fast track to poverty in the stock market. Okay, so we have seen four such strategies which could make you rich very quickly if engaged properly, or can make you go bust extremely quickly if proper measures are not taken while using those strategies. Okay, so we have learned in this video that the Indian share market is filled with incredible opportunities, but it demands respect. The rush of a huge win can feel exhilarating, but the pain of a massive loss can be devastating as well. Whether it is option trading, intraday trading, scalping, or investing in penny stocks, or try to ride the momentum in momentum investing. Remember that these all are just tools, not magic wands. They can build your wealth, or they can bring it all crashing down. So, if you are a serious investor about your financial future, learn the rules, understand the risk, and never ever forget that the very sword you use to gain a fortune can also be the one that cuts you down. Okay, thanks for watching this video. I hope you have learned something new today in this video. Please like, share, comment, and subscribe to the channel. Goodbye for now and happy investing.